Real estate investing can bring big reward and big risks. So know your risks. Welcome to the Real Estate Risk Report, the show for real-world insight on real estate investment risk. Now, here's your host, Lance Pederson.
Thank you for joining us. I'm your host, as always, Lance Pederson. This is the Real Estate Risk Report. So today I have with me, our guest is Rodney Thompson with Solaris Capital Management. How are you doing today, Rodney?
I'm doing very well. Thank you, Lance.
Very good. So Rodney comes to us from southeast Minnesota, so sort of from my neck of the woods, back in the good old Upper Plains, Midwest. He's sort of, I guess, equidistant from Iowa and Wisconsin, so kind of orient you. So why don't you sort of give us a little, intro in as far as sort of how'd you get into real estate? What kind of, usually a lot of it is sort of, a passion or something people kind of get into and realize like, this is what I was meant to do. So maybe share a little bit of your sort of origin story and ultimately what led to you sort of forming your own, Solaris Capital Management.
Sure. I originally got into real estate as I would say most people do, doing single families. It seems to be a very approachable asset type, and everybody kind of understands the concept of buy a house, rent it out. And but the heart was always been more into the self-storage side of things, and I haven't migrated over into self-storage yet. But my wife always said that would be a good asset to be in, and we'd drive past a big storage thing, and she says that's what we need to own, and I was always saying, well, that's a great idea. How do you propose we do it on our salary, kind of thing? Yeah. And at that time, I knew nothing about syndication, and so we bought a house, kept the house, moved it, bought another house, kept the original house, rented it out, and we've done that several times. And then probably about 2.5 years ago, I really started getting into, a little bit more than that, because I've been in multifamily for 2.5 years. So I had a friend of mine at where I worked, which was a university north of here, and he was into the whole FIRE movement, the financial independence, retire early movement. And he had turned me on to a couple of podcasts, and I really hadn't listened to podcasts before that. And one of the podcasts that he pointed me to was Bigger Pockets. I think most people kind of teethe on Bigger Pockets. And so I started listening to there, and somewhere along the line, a guest came on talking about multifamily and the scalability of multifamily and how multifamily is valued different than your single family house. And it just made this light bulb come on in my brain. And so I started looking into syndication, and I understood that I needed a mentor because it's a very complex type of investment. And so I started looking for one. I found one, and I just began learning as much as I could about about multifamily investment syndication. And it's a great asset because as far as the risks go, and I know your show centers around that, I would say it's less risky. Now, you have a lot of people look at that and go, you're dealing with millions of dollars. How can the risk be less than dealing with a $100,000 house? And I would say, if you got one tenant missing out of your one house, you're 100% vacant. Yeah. And we invest primarily in workforce housing. So in other words, the C to B class housing, which is what most people that live in apartment buildings, that's the type of housing that they live in. Yeah. And that type of housing is conveniently located between the class A and the class C, where if you have people that move if they're making more money, they're in a higher end apartment. And if they're making less money, they're in a lower end, but then they move, everybody's income fluctuates. So it's kind of that really good happy medium. And so there's always going to be demand for it. And if you have a piece of property that is properly managed, and this is where we can get into talking later about the sponsor or the operator, as some people call it. If you have a property that's properly operated, it's I wouldn't say it's a slam dunk, but you can mitigate the risk a lot.
Yeah, exactly. I mean, there's so many benefits to sort of, like you said, I mean, the beauty of multifamily is people need shelter, right? Clearly from an operator's perspective, like you said, I mean, it's the economies of scale are there. So it's got a lot going, for it. And when you think through all of the different recessions and bull runs and all those sorts of things, it generally is going to, compared to the stock market, right? I mean, it's, using the word volatile is probably not even appropriate, right? Given the ups and downs that you deal with in the public markets, but like you said too, and it's just then even drilling down, it's just the whole, A class, B class, C class. I mean, when the going gets tough and, hit recessionary environments, it's just all supply and demand, like you said, people they're going to figure out that, hey, I can't afford $2,000 or $2,500 for, rent on this really, really nice apartment. I can make do with something more in the $1,200 range or whatever, and then those who are sort of upwardly mobile, they say, hey, I don't need to live in this class C. I can go and get in a really nice sort of class B apartment. Right. And so you kind of hit them, both directions. And then, the whole Jobs Act and just the ability to syndicate. So your ability to, bring multiple and have partners in and, you got many units, you got many investors, you've got, sort of has a lot of that, going forward. And then over time, obviously, real estate in general is going to have some sort of appreciation and
that was one of the really cool things with multifamily is the whole appreciation side, because multifamily has this cool thing called forced appreciation, where, a single family house, I can go in and renovate a single family house and bring it up to neighborhood comps and maybe make it valuable, a little bit more, but there's kind of a glass ceiling there with single family residents. And there's that glass ceiling with multifamily too. I mean, you can go in and over renovate a property and not be able to get your money back out of it. And of course you're answering to your investors on that, but we look for undervalued and apartment buildings that have deferred maintenance, where we can go in there and add value back to the property so that we can increase rents up to the same rents the area has. We play in the 200 to 400 unit area. And a great example is if I buy an apartment building that has 200 units and I go in there and I raise rents $50 over the 200 units, because let's say it's under market and I haven't done any other value add other than just bring it up to market. On a 6 cap, I can add $1.8 million of value to that property.
Yeah.
Which is something amazing, because I can't do that with a single family property at all.
Yeah, like you said, it's the pricing and the values are driven by they're driven by comps and other sales of homes similar, to those around you. Whereas in this, it's more mathematical, right? In the sense of, things, they trade at certain cap rates in certain markets for certain type of product. And if you can go and acquire it for less and drive NOI, so it's more performance driven, right? You can create more NOI, which is often what happens, right? Is that you get some mom or pop owner who's sort of like I said, deferred maintenance. They're just not putting money into it because they'd rather go on vacations or whatever they want to do. And, their expenditures, are trending a little higher. They've been paying attention. And then, right, that's opportunity for guys like you to go in and say, hey, I mean, it is what it is, like whether these owners realize it or not, they're basically, they're posting scores to the scoreboard. Right. And
exactly,
when you ask for a T12, like trailing 12 financials, and it's like, well, your expenses are running there. Like you let that happen. Right. And now your NOI is less because of it. And, and any other investor in the market's not going to be willing to pay you much more than this. Right. And so it's nice to be able to look at a T12 and it will tell you so many stories without even talking to anybody. That's right. Yeah. And then you can look at it and see what are the opportunities. And I think that's what makes it, it's hard work, obviously, to find properties that meet that kind of criteria. So with that said, for you, what are the markets that you're sort of looking at? Because I know that it's what most people say, and it's probably no different for you, right? I mean, you got to look at, you've got to be like beating the streets and making phone calls to brokers, and you could go 100, you could look at 100 potential deals and not find one that sort of meets, your criteria. So where are you looking? What is sort of your acquisition strategy, and which markets in particular are you, really interested in investing in?
Well, our criteria is, we look for places that have an upward trend in population and employment, job growth, and either a steady or a declining unemployment. Now, is that always easy to find? No, but those are some indicators that if we're purchasing assets in that market, that there's going to be a continued demand for them. Because if there's a declining population, then the need for housing is going to decline, and we aren't looking for that.
Yeah.
But prior to COVID, we were primarily in the Southeast. It's a very favorable market. It's a fair weather market, so you have less climate changes to begin, as far as like summer, fall, and winter to deal with. And so it's the Southeast is typically landlord friendly. And what that means for an investor is that if you have a tenant that ends up to be a non-pay, it's easier to work with that tenant or encourage that tenant to move out than it is in some of the other areas of the country.
Yeah.
But when COVID came, the ability to travel and that type of thing changed. And so I listened to, I'm friends with a guy down in Kansas City by the name of Logan Freeman, and he's always telling me to invest in my backyard. And I always tease him back and say, well, that's easy for you to say, you're in Kansas City. Yeah. But I am very close to a lot of major cities like Minneapolis, St. Paul, and I have a couple of friends that invest up there. And we have another podcast that's a roundtable that we do. And we did a market analysis of Minneapolis, and I was the one that was charged with doing all of the back studies, the demographics and the economic indicators and things like that. And I was amazed by how great Minneapolis is. So it really changed my opinion of the Midwest. And so I started looking in the Midwest because I can drive to Des Moines, I can drive to Cedar Rapids, I can drive to Minneapolis, to Madison and Eau Claire. And, it's a little bit farther to go over to South Dakota, but all of these areas are very close that you can drive to them within a day. And so I really started concentrating on those areas, and it's been a good thing. So I would, that's what we look for.
Yeah. No, and I think you're right. We had Anthony Vicino on, with Invictus. And
that's who I was talking about.
Yeah, that's right. So he was obviously bullish on Minneapolis, and sort of, you were involved in that analysis. And, to like Logan's point, I mean, one of the groups that one of our early clients on the administration side, and someone that, we allocated quite a bit of capital to early on, was the Wooster Investments based in Kansas City. And these couple brothers, three brothers actually from Eugene, Oregon, were in Portland. And they moved out there and went all in on Kansas City. Right. And so it's, I think that, obviously they same thing, you do your studies and you're like, hey, this is just going to be a great market. But, I think there is, to Logan's point, and, like, once again, Logan went in, and I think that, those guys are newer to the market, or at least as investors, right? Compared to like the Woosters. The Woosters are like, dude, we're going to own Kansas City. Well, 5-6 years later, I mean, that's the beauty of real estate, is that even when someone is making a concerted effort to go own it and dominate it, they still can't control the whole thing, right? Like, that's the beauty of it, is that there's always opportunities. A lot of it, of course, is sort of, it's it fundamentally, it's relationship driven, right? And so you got to build relationships, and I always say relationships aren't scalable. You can't maintain 300 high quality relationships. It's just impossible.
Mm-hmm.
And everyone else has their limits. My mine's like 4, and maybe, others are probably more gifted than me in that department and can do 30 or whatever. But, that's sort of the beauty of it. And I agree, like the backyard thing, and for you, like it could be the benefit as a great example, right? Is the fact that, you're not in one of them, but you are pretty darn close to a handful of them. And I've always been bullish on Iowa. I mean, I think that it's an interesting thing. There's not one huge market there, right? It's sort of sporadic and spread all over. There's cities and all over the place in Iowa.
Yeah.
Right? That have good economic basis to them, right, in their own right. So
yeah, a lot of people look at Des Moines and kind of poo-poo it as a small town, but the MSA is really 625,000 or something like that. So it's a pretty good size town all in its own, plus capital city.
That's right. But the issue, right, of course, they look at it on the surface and it looks like Des Moines proper probably only has 175 or 200,000 population or something like that.
Right.
Exactly. So then it's misleading. Right.
And like you said, I don't think that everybody can know everything about every town in America, because Montgomery, Alabama, I'm thinking most people know about Montgomery, Alabama, and we've got a property down there. But when we were raising capital, a lot of people said, "Where's Montgomery?" And I'd kind of laugh because it's not exactly a small town. It's a pretty good sized town.
Yeah.
And so I think you run into that, wherever you go. But as an operator or a sponsor, you are in charge of educating your investors and showing them why this is a good place to place their money.
Yeah, that's right. And I think that's where, another theme that comes up often, right, is it's conviction, right? And so conviction around the strategy, right? And so market is so important, and obviously sub-market is probably even more important, right? But to the degree that you're passionate about a given market, it means that you're going to, by very nature, be able to pass judgment on, I like this market, I like the Portland metro area, right, as an example. But dude, there's certain sub-markets I would never buy a property in this area, right? There's certain ones that I would, because it's just in every market has those little nuances, and knowing the difference, knowing the difference, I think makes a difference. And, and that's the sort of thing where your investors now, that's the beauty of it. They could be everywhere. And that's for a lot of people. They're like, hey, I live in San Francisco, but I don't want to invest here. For us, we live in Portland. We rarely ever invest in Portland. We like the Midwest too. Now we're not operators, right? So we're finding operators to invest with. But that's what we're looking for. Conviction. Who has conviction over what it is that they do? Because even sometimes when the market isn't going there, that's the beauty of it, is that it might not have, maybe there is out migration and not in migration, and maybe it's this or that. But the best real estate investors still know how to make money in, markets where they've basically said, I'm convicted, I like this market. In the long run, it has good fundamentals, and I can buy stuff and add value. That is up to the operator. It's up to the sponsor to articulate why, this particular market has the things that it needs, and the projects and things that they find, sort of meet their criteria and their ability to execute, on those.
And I think that, investors, they kind of have their, some of them have their criteria, and some of them just have an affinity for a certain thing. Like I had a guy contact me the other day off of LinkedIn, and he was asking me if I have any investments in Cleveland. And I said, no, I don't invest in Ohio. I said, are you set on Cleveland? He goes, oh, absolutely. It's got to be Cleveland. Yeah. And I think that, he was probably the type of investor that would like to drive by whatever he's invested in and look at it. And there's nothing wrong with that. But that's what he wasn't open to anything else. But that's his thing. And then there's other people that they don't care where it is. They just want something that's cash flowing.
You got it. That's exactly right. And that's what I mean. Everyone has, whether they realize it or not, they've got their own investment mandate, right? Whether you're an active investor, which is what we're talking about right now. This is your mandate. Like to you, it's got to look like this. It's got to be here. These are the areas. This is what I'm looking for, right? And I want to acquire. And then you've got other people on the passive side who are saying, I only want to invest in Cleveland. Well, that narrows it down. What kind of property? Where at, right? And then they've got to sort of back into who the operator or sponsor is going to be. But that's his mandate. And to that point, I mean, this is why I'm in my day job when I'm not doing the podcast, right? We created the VeriVest sponsor directory for that reason, knowing that that's how investors look at it too, even the passive ones of all shapes and sizes. They have a very specific thing, whether they're some family office or some, private equity firm, real estate firm, they've got a mandate. We're looking for these sorts of things. We're bullish on Charlotte. We're bullish on Pensacola. We're bullish on Austin. We want ground up multifamily development here or there. Right. And so it's, I think for me, my passion's obviously trying to get more participants into the space. Like, hey, if you're accredited, you should be really taking a long, hard look at investing in syndications or real estate funds, as a way to sort of, make your real estate allocation. But ultimately, right, it's like help match people up because everyone has preferences. They always have and they always will. And there's so many people. That's why I say real estate, fragmentation's a feature, but it's fragmented everywhere. There's all sorts of investors and all sorts of operators and all sorts of real estate. How do we sort of match people up more efficiently so that people find each other so they can, do transactions?
And that's why we've kind of settled on the 506B model, because we can have non-accredited or sophisticated investors to give people an opportunity to get into the space that maybe aren't sophisticated yet, but aren't accredited yet, but they want to be able to invest because they've been saving with the intention of investing in real estate, and they're looking for something that's risk adjusted. And multifamily is one of the best is out there as far as risk adjusted. I mean, you look at the volatility of other spaces in the commercial property area, and multifamily is pretty much dead on.
Yeah, and it certainly is. It's like I said, it's probably the most stable, and it's clearly the easiest to understand, like to get into from a passive. Like you understand that. Oh, it's in this neighborhood. This is what it looks. They're adding a washer and dryer to the units or whatever. Like those business plans make sense. Where some of these other asset types, property types, like office or retail industrial, which are more like lease driven. There's other things at play that you have to. It's a little more complicated. Right. Like, why those things happen. We all understand. We've all probably lived in an apartment at some point in our life. Right. And, it just makes sense to us. Right. And I think that therefore then the business plans sort of are easier to get your mind wrapped around and sort of sanity check. Like, does this seem reasonable? Right. Like, are they really going to be able to raise rents right now? Like, $300, like it's easy to push back against something like that because you're like, that doesn't seem reasonable. Whereas someone else with a office building or something, maybe it's just it's just a different. It's harder to decipher if you don't know. So it's definitely an easier entry point.
One of the recent things that's happened that we're still living in, of course, is this pandemic. Because I think when this whole started, there were a lot of people that thought that. Well, the sellers were lined up for like another 2008, right?
Yeah.
And I think the buyers thought that there was going to be this correction because, I mean, you heard people talk about market correction forever because we're living in such a bullish market for such a long time. That's his record that it's been this long.
Yeah.
And so everybody thought that coronavirus was going to be that moment. And so lenders pulled back, sellers pulled their properties off the market. Buyers, thought they were going to get this great deal, but it didn't ever come. And this really is a testament to multifamily because what we call collections, which are our monthly rent that we collect, stayed high, over 90%. And that was bolstered, I think, by the stimulus checks, that came out.
Certainly.
But the fact is that property values didn't go down, and all through this second half of 2020, property values stayed high, and everybody had to readjust on the fly. And I think that there were some people that were saddened because they didn't get a good deal, but sellers were grateful because they were able to still sell their properties and get the value out of them that they wanted. But the operators that were currently operating properties, they were grateful because their property values didn't decline, their collections didn't decline. And it's just a testament to, because if you remember back in, was it March or something, when stocks took a 25% dip and everybody was kind of freaking out over that, wondering where the bottom was going to be. And multifamily straight on, didn't hardly dip at all.
Yeah.
And so that's a great thing to use to illustrate people. It's like, hey, if you're, being diversified in your investments is a good thing, but where is that diversification? Across what asset types do you have that diversification? Multifamily is one that's a very good thing to have in your portfolio.
Yeah, definitely. Yeah. And you saw it sort of was resistant to that and has held up well. And, and obviously it's had its struggles in certain pockets and like you said, I mean, Class A sort of product, maybe suffering a little bit more, and there might be some distress there, right? It's just when the banks and the lenders lose their patience and, they're just not, those sorts of things. But yeah, I think overall, right, it's held on pretty good. And it makes sense. I mean, this sort of, no one underwrote for a pandemic, but the pandemic did anything, it sort of forced us all into our homes. And so, it just goes back to that shelter argument that many have made over the years of just, it can't be overlooked. Like it's sort of like, yeah, shelter. But well, it is shelter. And in this case, we all appreciated our shelter, and we certainly didn't want to do anything to jeopardize it. Right. And find ourselves out on the street and those sorts of things. So yeah, I think, it's a great way to get in. It's a pretty solid thing in terms of, if you need some exposure to real estate, multifamily is, you could do far worse. Right.
Absolutely.
So for where can folks sort of find you? Like what did, maybe share with us. So you've got a website, and you may have mentioned a few of these podcasts, people can check out.
Yeah. So my website is solariscapital.com. I'm sorry, it's not. That's the website that I'd like to have.
Yeah, exactly. Someone else got it.
It's one of those premium websites that for some reason the web gods out there deemed as, prime.
Yeah, of course.
Premium. So one of these days I'll shell out the cash for it. But in the meantime, I have Solaris CM for capital management. So solariscm.com. You can reach me at rodney@solariscm.com. I'm also very active on LinkedIn. So if you go search me up on LinkedIn, you'll more than likely find me. And we have a podcast. I actually have two. One is called the Weekly Multifamily Roundtable that I do with Anthony Vicino and Dan Kruger out of Minneapolis. And then I'm working on launching my new podcast, which will be the Mindful Capitalist. And we're going to be looking at, mindset and how that affects one's success.
Cool. That's great. Yeah, we'll be on the lookout for that one. Well, it's been a pleasure having you on, Rodney. You have a great one. Take care.
Thanks a lot, Lance. I appreciate it.